Hallo und herzlich willkommen zum Trading-Podcast der 𝘧𝗿𝗏 Investment Academy. Hier ist euer Host Oliver 𝘧𝗏𝗏.
Hallo und herzlich willkommen zur Börsenschule, dem Trading-Podcast der 𝘧𝗏𝗏 Investment Academy. Wir haben heute mal ein ganz besonderes Projekt für euch geplant. Wir werden heute unsere erste Folge in englischer Sprache veröffentlichen. Wir haben nämlich einen ganz tollen Gast für euch mit dabei. Das ist der Jason DeLorenzo, der Wizard of Options. Jason wird euch gleich noch mehr darüber erzählen, wer er eigentlich ist und was er macht. Er hat auf jeden Fall eine ganze Menge interessanter Dinge zu erzählen. Für alle diejenigen unter euch, die der englischen Sprache nicht mächtig sind, ihr könnt gerne rüber switchen auf YouTube. Wir veröffentlichen unsere Podcasts ja grundsätzlich gespiegelt auch auf unserem YouTube-Kanal der 𝘧𝗏𝗏 Investment Academy. Dort findet ihr die gesamte Folge als Video mit deutschen Untertiteln. Wer also das Ganze sich auf Deutsch angucken möchte, beziehungsweise zumindest mit deutschen Untertiteln, der kann das Ganze auf YouTube tun. Alright, without further ado, let's switch over to English. Hello, Jason. So nice to have you here.
Oliver, how are you doing?
I'm doing great. How are you?
I'm doing well.
Perfect. So before we start talking about our today's general topic, which is dealer positioning and dealer hedging, could you please be so nice and tell us a bit about yourself? Who are you? Where do you come from? What brought you to trading?
Sure. My name is Jason DeLorenzo. I am the owner and founder of an American registered investment advisor called 𝘚𝘰𝘧𝘵𝘢𝘏𝑒𝑚 Funds. I have a bachelor's and master's in economics. And as an economist, I mean, it's kind of in our training to always just search for inefficiencies in everything. I mean, even yesterday, my wife was joking around, talking about how at the grocery store, how even on sale items, I'm sitting there parsing pennies on unit prices on items that we need. People made fun of me. I go to fast food and order combo meals individually so that I could save 40 cents. But I mean, when I started turning to the markets, I saw that options had such an array of trading possibilities, and the plumbing, like how options work and how they're processed and executed, lends itself to a significant edge. And so I kind of dove head first. I learned, I read books and I read academic papers. I got mentored for a year from a former market maker. And honestly, I mean, I was also enrolled in the School of Hard Knocks for a while too. But then things began to really click, the practice and all the education, as started kind of contributing on some message boards and on Twitter, and started gaining in popularity. And after a while, I think in 2018, my wife and I decided, we should start a business. We should start doing this, and that's where we are. Okay. So we have a business, both providing data to customers and also providing money asset management services, and specializing primarily in options and finding edge in the whole kind of options plumbing.
I see. Since you studied economics, have you always traded options, or have you started with something else before you actually came into the world of option trading?
Well, economics is different than finance. I mean, economics is more about social science and how people act and incentives and price, and money is really just a measure of why people do what they do. So, but finance is kind of more where the options and, I started in just straight equities and really kind of more traditional investment practices, but I kind of felt that there was something more that the market was offering. And, and when I started looking more into kind of the different tools, I mean, options, stocks, bonds, they're all tools that are trying to give your money an expression of what your opinion is. So when you trade options, you have a lot more flexibility in how your opinion can manifest itself in your portfolio. So, for instance, with options, there are puts and calls, which if you buy a put, it is bearish. And if you buy a call, it is bullish. But you could also sell a put and sell a call. So, if you think you may be bullish, but, it's not, the market's not going to go too high, then you can sell a put. There's also, because options are a derivative product, meaning that their value is based on other factors, not on itself. Like if you buy an Apple stock, it is based on the company's performance. But if you buy an Apple option, it is based on the price of the Apple stock at a time for a certain price. So there are a lot more variables that go into options, and that allows, for me anyway, a lot more flexibility in expressing my thesis using that tool. Of course, obviously, there's stocks and bonds.
Absolutely.
And, traditional things that also help express that, metals, gold, crypto. But options kind of, that's why I kind of gravitated more toward options, because it's just a little bit more specific in how you can
absolutely
trade.
Yeah, I feel you. I mean, options are a very powerful tool, but they're also a complex tool, which people have to dive really deep into to fully understand what options actually can do, what they're capable of. Absolutely.
Yeah, sometimes you have to learn about them before you find out the hard way, right?
Absolutely. But I guess this is true for like every discipline in trading at all.
That's true.
Yeah, right. So you said you actually have two companies that you're head of. One is for data providing. We'll dive deeper into that in a minute. The other one is your fund, which is called @𝘚𝘰𝘧𝗏. Can people actually invest in you as a trader? I mean, me as a retail trader, can I give you my money and say, Jason, make something out of it?
Yes, you can give me your money. That's all. We'll just stop there. You can give me your money.
Just give it to me.
Yes. I do manage funds. Really, we're kind of really ramping up that side of the business using the data that we have from the data providing, which I'm sure we'll talk about soon. But yeah, I am registered, so I'm allowed to invest your money if options turn out to be too difficult, but you want exposure to that space. This is a place to come.
Perfect. So everyone who's listening, check out @𝘚𝘰𝘧𝗏.
Yep.
Coming over to our general topic today, which is dealer hedging. Can you tell us a bit about that? What is dealer hedging? Why is it important?
Sure. So I just expressed that how flexible options are. Because, if you open up your brokerage account, you see a whole slew of strikes. You see a whole slew of expirations, and they're all different prices and, a bunch of different equities, and there's options on all of these things. So in order to maintain liquidity in those options, it's not like an equity. An equity, if you, Oliver, want to buy a stock and I want to sell it, there's a middleman that can see who wants to buy and who wants to sell, and they exchange it. Because options, if I want to buy a $400 Apple call for 3 years from now, there's not going to be many sellers out there for that. So there's these middlemen called dealers that facilitate that trade. They take the opposite side of everybody's trade that comes through the market, of course, for a price. And their job is to hedge the risk of the opposite of my position. So if, again, I want to buy an Apple $400 call, they have to, they are short that call, and they have to go a little bit long in order to hedge that position, because at least until they find a buyer or a seller for that $400 call. So they want to remain risk neutral and keep the price, the spread between the bid and the ask of the option, and hedge away all the rest of the risk, and they make pennies on each option transaction. So a dealer is that middleman. They hedge all their whole option book. Of course, every dealer has more than one option, and they use various tools in order to maintain risk neutrality in their options book.
Absolutely. So let's assume we're trading the SPX options, and I'm a private trader who tries to buy a call in general. So you're the market maker, you're the dealer that takes the other side of this trade, and you obviously have to build up some kind of hedge now.
Right.
As soon as you're in that hedge, how do you actually do that? What kind of instrument do you use to actually facilitate this hedge?
Okay. Well, first, we should take a small step back and define what an option is, because it is a contract for somebody to buy or sell the underlying equity. So like, the stock or the future or whatever, at a certain price by a certain time for a premium. So there's several different variables that you kind of hear when you hear that definition. The first is on a certain underlying. So there's a basis of that price of that underlying. So if you wanted to buy a call and I'm the dealer and I'm selling you that call, that puts me in a bearish position. So in order to, one way I can hedge is to buy the underlying. You said SPX. In SPX, they buy ES futures in order to hedge their underlying. There's also the time aspect. You kind of heard that variable in there. So as time goes on, it becomes less and less likely, or, if in the money, more and more likely that option will be worth money at expiration, that it will be able to be exercised and give you kind of a premium, or, give you that underlying stock. So time kind of has an aspect, and there's also a price, a premium in there. That is meant to measure volatility. So there's several different things, that the market maker has to hedge for all of those things. They hedge the volatility in SPX. They hedge it with VX futures. Same with time. Time kind of is reflected in that premium. So there are many different ways that market makers hedge. Their ideal, obviously, is if you want to buy an SPX call, is I find somebody else who wants to sell the same exact one, and I just exchange it. That's the ideal, because that's completely risk-free and I'm not managing anything. But that's more and more rare. So the market maker is continually trying to use the underlying primarily, but also correlated instruments in order to hedge the risk away.
Absolutely, yeah. And now the important thing is, as soon as one of those three factors, the price of the underlying, the volatility, or the time, as soon as one of those three factors changes, the market maker or the dealer is actually forced to adjust those hedges, to actually buy back some of his underlying ES futures, SPY, ETFs, whatever he used for hedging, and actually adjust his position. So why should I, as a retail trader, care? Why is it important for me, the whole topic? And actually, why does it become more and more important from year to year?
So as a retail trader, even if you never bought an option in your life, these option dealers are buying and selling those underlying in order to hedge their position, which means that they are having an effect on your stock. If you have, let's make it simple and just say an Apple position, and, you are long Apple shares, the dealer, by hedging their book, can buy or sell Apple shares and affect your portfolio without any fundamental thesis whatsoever. They are, what we call price agnostic, which means they don't care what price Apple is. They're going to buy or sell in order to stay risk neutral. So as a retail trader, it's kind of, since options are a derivative product, we say, it's like an expression in America, it's the tail wagging the dog. This thing that's meant to hedge underlying movement is actually causing the underlying to move itself. So it's very important to know as a retail trader, why is, the PE ratio of this stock so high, particularly something like Microsoft or Tesla or something. And many times, especially with the large cap stocks that have a lot of options traffic, a lot of times it's because those dealers are hedging bearish bets that, they have to, they are hedging positively on, and it makes the price of your stock go up, 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 up. And you can have a fantastic fundamental thesis, and the option dealers can wipe it away without any fundamental thought of the underlying whatsoever. So it's something that you definitely have to keep track of, even if you're only trading equities.
Right. So the dealers, just by adjusting their hedging positions, actually take influence on the underlying that I personally, as a retail trader, am holding.
Exactly.
So they're actually moving the price further up or further down, which definitely is important for me and my position that I'm holding. So
that's right.
But there a way
I didn't answer your second question though. It becomes more and more important, because especially since the pandemic, options volumes have skyrocketed, and it has come to a point where there is more money, we call it equity notional, more money traded in options than there are in stocks. So those dealers, those middlemen, their book is getting larger and larger and larger. And that means that they are hedging stronger and stronger and stronger. So even, macroeconomic, or fundamental traders are getting overwhelmed by the dealer hedging on many stocks.
Yeah. I can totally rely on that. I mean, it's like, I think like 5 years ago, barely anybody was talking about this kind of topic, about the dealer hedging topic. But nowadays it becomes more and more important, since exactly what you just said, the option markets grow from year to year, and the further they actually grow, the more influence they actually have on the according underlyings. So is there any clever way that we can actually take profit on that? Or, I mean, is there any way that we can follow those positions and those hedging activities of the dealers?
Why, of course. That is the data that we...
Well, speaking of.
Yeah, so we have developed, a dashboard called Volland, www.vol.land. And it is a comprehensive look at the option dealer positioning for over 200 equities, equities, ETFs. We keep adding, so I kind of have to give the over 200, but and soon to be futures options too. So that is the mission of the dashboard that we have. It's back, you were saying 5 years ago nobody was talking about it. This was kind of brought into the public consciousness by a company, I guess, called 𝘧𝗿𝗱𝗍𝒐𝑠, who started writing white papers on the subject. In his white paper, he was talking about how, for the most part, options are a hedging tool. People buy stock and then buy puts in order to hedge their stock. And he had an assumption where all the puts were bought and all the calls were sold, which at the time was pretty effective. I mean, it was pretty true. But as the options popularity grew, that became less and less true. And now it's completely false. There's so much different positioning in options and in every equity that it's you can't really determine who owns the puts and calls, and who's buying, who's selling, just from a blanket assumption like that. Many of my competitors hold to that assumption. Anytime you see the word GEX, GEX, they're usually holding to that assumption. What we at Volland do is, instead of assuming that we, in America, they have the options pricing, over OPRA, option pricing regulatory authority, and they have a feed of every single options transaction as it's happening. And so what we do is we take every single option, tens of thousands per day, really millions per day across all equities. And we take each of those transactions, categorize them as dealer-owned or customer-owned options, and then build the dealer book out of it, and then show you the relevant hedging that the dealers have to do with regards to the variables we were talking about before. The underlying price, known as gamma or delta. I mean, they're two different things, but gamma and delta. Underlying volatility, which is vega and vana, and then the underlying time, which is theta and 𝘌𝘉. So basically what Volland's trying to do is give you a heads up as to what dealers are going to have to do in the near future in order to hedge their book so that you can make a determination on what the price of the underlying equity would be.
Mm-hmm. To further emphasize your argument, what you just said, that it cannot be true anymore, that the assumption that all calls are sold and all puts are bought is no longer true. I think the whole GameStop topic was a really good example. Can you maybe tell us a bit about your thoughts on that? What actually happened there and what kind of influence the option markets played there?
So GameStop is and this is true, GameStop is just one of many things we kind of call the meme stocks, the meme stocks, which all of a sudden these stocks that really are bankrupt companies or companies that were really struggling, they explode into, this unrealistic valuation that nobody understands how that happens. Part of it was options. Part of it was something else called short covering, but of course, short squeeze. But it's kind of the same idea. What ended up happening was GameStop is a company that sells physical video games, which now, physical video games are more and more becoming a thing of the past, kind of like physical DVDs are. But GameStop did not adapt to the new environment, and they ended up being an unprofitable company with very high overhead, a lot of debt, and they were in trouble. And a lot of hedge funds and a lot of fundamental funds, in particular a fund called Melvin Capital, they shorted the equity of GameStop. And there was so many people betting against GameStop that, the short equity was larger than the number of shares outstanding. So, somebody would short and then lend their short share again multiple times to other people who are trying to short this stock. So there was a lot of people shorting. The thing about having short stock is you can have infinite losses and only a little bit of gain, a finite amount of gains if the stock goes to zero. And what happened was there was a group on Reddit or Wall Street Bets that decided, there was a very popular person, the screen name Roaring Kitty, I forget his real name, but he felt that there was value in GameStop. And he had a fundamental thesis, also knowing that there were a lot of people short. And he decided to start buying. And he got this whole community of people to start buying, including buying calls. And what ended up happening was between that group, the people buying the stock, and the dealers who are hedging their short calls positively and having to buy and buy and buy more, forced these hedge funds that were short to have to cover their positions because the clearinghouse, the risk management company that they were, you call it their counterparty, was demanding that they have to cover their positions. Otherwise, everybody can go bankrupt and blow up. And that would be very, very bad. So they had to start buying. So then you had three parties buying, all with strong pockets and no party selling. You had these Wall Street bet people, you had the option dealers start buying, and you had these people who are short equity being forced to buy back their short sales. And it turned into an explosion because it was an illiquid stock to begin with, meaning there's very little volume and very few people trading it. So it went from, $20 to $400 really, really fast. And a lot of people tried to get on. They ended up buying too late, or, it turned into a huge debacle, really. But that same playbook is sought after and played on a lot of stocks. Hertz went bankrupt, and somehow its stock exploded from $1 to $16 overnight. AMC during the pandemic, the movie theater, a similar kind of thing, although they didn't explode quite as much. But so these meme stocks, they have very little fundamental value really whatsoever. But all of these parties had to buy. They were forced to buy, and that's where the edge was. That's what happened to those stocks.
Absolutely. So you just said people were massively buying calls because they were actually speculating long. They were actually expecting the stock to rise in price. And by buying those calls, they actually forced the market makers, the dealers, into short call positions, which they actually had to hedge by, again, buying the stock, the underlying stock. So more and more buying forced the actual stock price to go up and up and up.
That's right.
This actually, and that is what I actually wanted to say. This actually proves everybody wrong who still defends the assumption that all calls are actually sold by traders, which cannot be true. Exactly. So what are you actually doing different in Volland? What is your kind of approach to that?
So, once again, the thing that, we ditched all assumptions as it relates to open interest and, and just assuming who owns the puts and calls. We, using obviously technology, we go through in real time every single option order and determine with kind of our own algorithm. We determine who is buying that option. Is it a customer or is it a dealer? And, which one is selling? And we take the dealer side of that ledger. We calculate these variables, how much the dealer has to hedge in underlying time and implied volatility, that delta, gamma, we call it the Greeks. We calculate the dealer Greeks, aggregate it for how many options at each of these strikes that they own, and then display it. Then, for all expirations, for all strikes, for over 200 equities, we put it out there so that you can look at it and say, oh, they're going to have to buy or sell at these critical price levels.
Yeah, absolutely. So honestly, I was really, really happy as soon as I found out about the existence of Volland, because I myself was customer at a big competitor of yours for many years, and this platform actually is based on this old assumption that all calls are sold and all puts are bought. So I think what you're doing is really great. It's a really great concept, and I really also love the whole build-up of the Volland dashboard. It's clean, it's easy to use. Of course, the topic itself is really, really complex. It's not that easy to explain, especially in just some minute or a short podcast. So I hope everybody out there listening right now goes easy on us. We won't dive too deep into that topic today, at least. But if you're interested in the whole topic of dealer hedging, definitely check out Volland. It's a really great tool. It's a really great platform. We We also have a kind of discount link. You can find it beneath the video in the description. So if you want to check out Volland and try it out, maybe for a month, and see what they're actually doing differently from other competitors, I would definitely tell you to go there, check out the platform. And if you have any further questions on this, can people actually contact you?
Yeah, absolutely. Actually, I was going to say, if you just click on the link and you only subscribe to Volland, you're going to probably look at it and be a little bit overwhelmed. I would suggest that you join our Discord group. I'll provide Oliver a link. And also there are YouTube videos. If you look up Wizard of Ops, there are YouTube videos that are instructional. I would, Oliver might kill me because, it's affiliate, but I won't. When you join Volland, I want you to know what you're looking at. I want you to be able to feel comfortable with it, not just buy it and think it'll solve all your problems. So check out the YouTube videos and join in Discord. There's plenty of people, myself included, who are more than happy to help guide you in your investment journey. So get familiar with it, get familiar with the concept. And once you feel comfortable with the edge, which does exist, then that's when I recommend you subscribe and check it out and use it in your investment decisions.
Exactly. Jason, thank you so much for being here with us today. I hope actually that we can repeat this if you'd like to come back anytime. So maybe next time we can dive a bit deeper into the concepts of gamma, vena, and charm.
Absolutely. This was a pleasure, Oliver. Thank you.
Great. So have a nice day, and everybody out there, we'll see you next week with the next episode. Let us know what you think. If you like the whole concepts of doing some interviews in English language too, just let us know if you like to have any further information on the whole topic of dealer hedging, which actually, as we just said, is a very complex topic. We'll look forward to hear from you about all your thoughts on the episode. Have a nice day, everybody, and good trades. Bye-bye.
Take care.